Okay, why don't we go ahead and get started? So in the interest of time, I'm going to give very, very brief introductions of our two speakers today. So first off, the main event is Andrew Schwartz. So Andrew Schwartz is a professor at the University of Colorado Law School, where he teaches on corporate securities and contract law and has become an internationally recognized expert on investment crowdfunding, and that is what he will be talking about today. And he's going to be discussing his recent book named, appropriately, Investment Crowdfunding. So we're looking forward to that. And then to get some context and some commentary, we'll be hearing from Jamie McNally, who is a director at FrontFunder, Canada's leading investment crowdfunding platform. So she'll be able to give us some real-world context for Andrew's talk. So without further ado, why don't you please tell us about your book?
Thank you very much. It's really a pleasure to be here. I didn't know that it's sunny all the time here in Vancouver, but now I do, and I'm going to tell the world. It's absolutely beautiful here in the city and on this campus, and so happy to be here as well. Camden, maybe I'm not that memorable, or maybe I grew a beard, but we met a few years ago out in the lobby here when I was doing some initial research on this subject, and it's been very useful for me to get the international perspective, as I'll discuss here today. So, let me also definitely please thank Jamie McNally, a Saskatchewan native, which is notable because I make a slight bit of fun of Saskatchewan in the book, but with love in my heart on this Valentine's Day week. Investment crowdfunding, it's the name of the book, and it's a new type of online public stock market that is open to everyone, and usually the most basic rule of securities regulation, of regulating the stock market, is that before you sell securities, any sort of financial interest to the public, as opposed to your personal friends, you must, quote unquote, register those securities with in the United States, it's the Securities and Exchange Commission. Here we have the BCSC and other provincial regulators. And registration means filing a huge stack of disclosures, information about the company, so that investors know what it is that they're getting into. And disclosure is a useful thing, but it also costs money. And so, at least in the US, I'm not sure what the figures are here in Canada, in the US, the process of registering your securities, more commonly known as an IPO, an initial public offering, it costs $3, $4, $5 million US to go through that process with lawyers and accountants and investment bankers, and it's an incredibly expensive process. And so if you're seeking to raise $500 million or billions of dollars, sure, go ahead and file your registration documents and go on the Toronto Stock Exchange. But if you're only seeking to raise, if you're a startup or a small business and you're seeking to raise $200,000, $500,000, $2 million, it literally makes no sense, and it's effectively impossible to spend $2 and $3 and $4 million in the process of doing it. So for decades, startup companies have been funded not through public investment, but through exemptions to the general rule that securities must be registered. And the two most important exemptions are, and these are in the statutes, are that if you sell securities, meaning financial investments, just to people that you personally know and your family and friends, that is not a public offering, and so you don't have to register the securities. More importantly, if you only sell your securities to wealthy people, In the US, we call them accredited investors. Some countries, it's called wholesale. But if at least in the US, if a person has $1 million or more of investable assets, they are considered accredited, and they are allowed to buy securities that have not been registered through this formal process. And so the upshot is that the wealthy and connected have for decades had the exclusive ability to invest in startup companies. Venture capitalists, angel investors, these are accredited investors, but the broad public has not been allowed under the law, and it's a law with good reason. We don't want normal members of the public who don't have $1 million to lose to invest in speculative startups run by people that they don't know. But on the other hand, normal people, non-wealthy, non-connected people, are allowed to buy a giant pickup truck, or go on a $10,000 trip to the Bahamas, or gamble their life savings in Las Vegas, or, I don't know, Montreal. But so, as a matter of freedom, it was thought, wouldn't it be nice, wouldn't it be useful if ordinary investors were invited to participate in the market for startup companies? And looking to the example set by Kickstarter and other what I call reward crowdfunding sites, where people would put in money towards a project and not receive any sort of financial interest, that would be against the law, but they might receive a t-shirt or their name in the credits of the movie or the special smartwatch that the company is developing. They could receive some sort of reward. And so that was called crowdfunding. And so about 10 years ago in the US, there was a new exemption added to the securities laws saying you can avoid registration if you follow this other set of basic rules and pursue investment crowdfunding. And so the US passed a law in 2012, New Zealand in 2013, the UK has been doing it for a while as well, and Canada, it took a little while to get off the ground. Here in Canada, we have a single SEC in the US, Securities and Exchange Commission. Here in Canada, you have provincial regulators. And starting in about 2015, Saskatchewan was the first mover. Saskatchewan came up with its own investment crowdfunding scheme, but it was only limited to Saskatchewan. Alberta had one. There was a consortium of most of the provinces that agreed on a way to do this, but Ontario had its own way of doing things. And I only spend about 2 pages in the book recounting the tortured history of investment crowdfunding in Canada, but eventually in, I think it was 2020, maybe Jamie knows more precisely, it could be 2021, there was a single national instrument that was agreed to by the various provincial regulators. I believe it's called 45-110. And this was actually a pretty good law. Really, I think quite well done. Canada, like I have made fun a bit, kind of was a little bit behind its peer countries, and it took a number of years to get this finished. But the benefit was Canada got to look out across the world. How is Australia doing it? How is the UK doing it? And put together what I describe in the book as really pretty good set of rules. And just before I get to the rules, in 4510, 110, excuse me, let me see, my presentation basically has 2 more parts. First, I'm going to tell you very little bit about the law, and then I'm going to tell you more about other, what I call in the book, private ordering mechanisms, non-legal methods and mechanisms that make this market effective, or help make it effective. And let me invite everybody to grab some pizza as we're talking. Please do. It's hot and fresh from Uncle Fate. All right. I can't say that on the air. So, regarding the law, as Camden generously said, I'm an international scholar of mystery, of investment crowdfunding. And looking around at the different countries, I've kind of separated them out. Dozens of countries have adopted investment crowdfunding laws over the past 10 years. But in the book, I take a sample of some of the biggest markets, and I divide them into two types of legal regimes. One, I call the standard model. And I call it standard because it's the model that the US led off with 10 years ago in the quote-unquote Jobs Act. Jobs, jumpstart, I don't know if you do this in Canada. In the US, all of our statutes are like acronyms. So this was the Jobs Act, the Jumpstart Our Business Startups Act. Also, hopefully make some jobs. The Jobs Act kind of set the standard and used the standard mechanisms for regulating securities sold to the public, namely mandatory disclosure. As I said, the core rule is you have to give a whole lot of information to the public so that they can make decisions. And this is a law, so it's called mandatory disclosure. And even though the Jobs Act eliminated the traditional mandatory disclosure that would be required for an IPO, our Congress substituted a sort of miniature set of mandatory disclosures. And so that's the standard model, and it relies on mandatory disclosure. But there's a downside to mandatory disclosure, which is, as I've mentioned in probably my first sentence or two, it costs money. And the mandatory disclosure called for in U.S. law and various other countries is much, much less onerous than what is required for a traditional public IPO. However, it's still pretty substantial. And it still costs, I'm going to wait to hear what Jamie has to say, but tens of thousands of dollars to comply with those rules, which can make it economically infeasible to pursue crowdfunding, because a rule here in Canada and a rule around the world in every jurisdiction is you may pursue investment crowdfunding and sell your securities in this way as opposed to the traditional public process, but there's a cap on how much you're allowed to sell. In the US, it's $5 million. A company can sell $5 million worth of securities. Here in Canada, it's 1.5 million Canadian dollars. New Zealand, it's $2 million. In Australia, it's 5. But each country kind of has its own level, but it's all about in that range. So for this market to function, the costs of complying with the law has to be extremely low, given that you could only raise under the law 1 million or $1.5 million or 5 or whatever it is. And so with that in mind, and one other rule that's in at least most jurisdictions, New Zealand's the outlier here, where the Congress in the US and the Canadian regulators didn't want individuals to put their life savings into these risky, speculative startup companies. Some of them are going to make it big, but a lot of them are going to crash and burn. And so there's a law in each jurisdiction, again, I think, except New Zealand, that says each individual is only allowed to invest a certain amount. And so in the US, it's a cumulative amount over all crowdfunded companies over a year. But in most jurisdictions, and Canada and Australia are exemplars, it's an amount per investment. And in Australia, it's $10,000. Here in Canada, again, correct me if I'm wrong, I think it's $2,500 per investment. And so one of them might go out of business, but the most that an individual can lose is $2,500. With this cap on how much a company can raise, and so therefore how much potential harm there could be if things go bad, there's not going to be any systemic harm from any single investment crowdfunding company going out of business. And because each individual is capped in the amount that they may invest, some jurisdictions, not Canada, but the UK and New Zealand in particular, adopted not the standard model, but what I call the liberal model, like a deregulated, a free model. And so in New Zealand and in the UK, most importantly, there are no mandatory disclosure rules. There is, which greatly reduces the cost of running one of these campaigns. And so those jurisdictions completely ejected mandatory disclosure, and in other ways, but that's the most important, created a very liberal, deregulated form of regulation. And as I talk at some length in the book, they're doing really well. The liberal jurisdictions have really outshined the standard jurisdictions. I mean, to the extreme, here in Canada, Ontario for maybe 4 years, had in place a pretty onerous set of regulations. And it was so effective that not a single company even ever attempted to use them. So for the market to be functional, the regulations need to be very minimal. But, and this is the final and most important part of the talk, so I hope you're paying attention. If the law is going to be minimal and deregulated, well, we might worry that con artists are going to sell phony businesses, or people will collect the money and run away, or there might be other problems for investors or for the market with a very deregulated system. Indeed, the whole premise of securities law in general is that we do want regulation on these sorts of offerings. But so what I spend a lot of time on the book is to describe what I call the private ordering methods, non-legal methods like economic incentives and market forces that should be expected to, in my experience talking to people around the world, but again, I'd love to hear what Jamie has to say. My experience has been that these are actually working quite well. Let me just begin with the conclusion. Those liberal jurisdictions like the UK and New Zealand have no more fraud or bad behavior than do the standard jurisdictions. Basically in each country, and I'm not sure about Canada, because it's all pretty new here, but in each jurisdiction where investment crowdfunding has been up and running for a number of years, there's like one case of fraud. And that's bad, but in the US we've had maybe 4,000 offerings here. And look, 1 out of 4,000 is really a quite good record. So how did the UK and New Zealand get there? And to some extent, the standard jurisdictions depend on these private ordering mechanisms. And I talk about probably 7 of them in the book. For right now, at least, in the moment, and maybe we'll talk more during the Q&A, let me just mention some of the most important. And the absolute most important is sitting right next to me. It's called, I call it, gatekeeping. One of the basic rules of investment crowdfunding is that I can't just set up a website and start selling shares directly. The law in every jurisdiction, even the liberal ones, require that investment offerings be posted on an independent third-party platform like FrontFunder here in Canada, sort of like a miniature stock market. And the business of FrontFunder depends on, and the other gatekeepers, depend on investors being satisfied and coming back again and again, because the way that they make money is like a percentage of the deal flow. So it is in the gatekeeper's interest, in the platform's interest, to kind of guard the gate and only allow legitimate, promising companies to list on their platform. Because if they don't, and they know that if they don't, and the fraudulent company turns up on their platform, or just a whole bunch of real duds, investors will go elsewhere. There's multiple licensed platforms in each jurisdiction. Let me just tell you one or two other private ordering mechanisms. So I'm saying this isn't by law. Well, the law says you have to go through a gatekeeper. But how hard should they work? Well, they work hard, is my experience. Again, I want to hear from Jamie, but from around the world, I've heard from the leading platforms in each jurisdiction that they reject upwards of 95% of the companies that seek to list. They're really quite strict. Another private ordering mechanism is, I call it the digital trail. The digital trail. And let me give you an analogy. Decades ago in Boulder, where I come from in Colorado, and in Cambridge, Massachusetts, and in Paris, and in Amsterdam, and other places, there were free bike programs. Like you could just take a bike and ride it around, and isn't that cool? That's great. Just bring it back. Well, like within days, every bike was stolen or destroyed. But these days, in New York, we've got city bikes, and in Boulder, we have B-Cycle. And I don't know what you call it around here, but there are these bikes that people can rent all over the place, and they're not all stolen and destroyed. Why not? Because to get a bike, you need to put your credit card in, and that makes like a digital tether between you and whatever happens to that bike. So you'll be much more responsible with the bike, and the system works. Similarly, in the olden days, before the original securities laws were put into place, people, and still to this day, people solicited their, people in public, hey, or knocked on doors to try to sell stock, or just talk to people at your, church or synagogue or whatever it is. And in real life, there's, and there still is, I don't know about significant, but there are some bad actors that lie to people and trick them into investing. But investment crowdfunding is a totally unattractive place for a con artist to pursue his trade, because every single thing that you say is linked to your username. And forever, I mean, the internet never forgets, at least in America. I'm not sure what the law is here. But the internet never forgets. And so whatever people say in the course of selling or promoting their securities on investment crowdfunding, there's a digital trail leading right to their door. So to pursue fraud on a crowdfunding platform would be like robbing a bank in the snow. Like, he went that way. And then the final thing that I'll say, and this is in Front Funder, makes an appearance in the book. It's in the index. I think it's on page 65, if you're interested. Remember I said the first principle of securities regulation is mandatory disclosure. But step back for a second. Do we really need to mandate disclosure? If I stood up here and said, hey, who wants to invest in my company? And Jamie says, oh, what does it do? And I say, I'm not telling. And Camden says, well, how much money did you make last year? I'm not telling. If I don't voluntarily disclose, nobody's going to invest in my company. And so when selling securities initially, now it might be different, I'll grant, once the stock is listed on a stock exchange, so maybe there is a place for mandatory disclosure. But when making a primary offering, when I'm trying to get people to invest in my company, there's a tremendous private financial incentive for me to provide voluntary disclosure. And guided by the platforms here in Canada and around the world, including in the UK and New Zealand, where there is no mandatory disclosure, the companies do voluntarily disclose a tremendous amount of information, not a wasteful amount, but an appropriate amount and in a format that makes sense to the investors, and various, in a private, just on their own way, Front Funder and other platforms have established things like their due diligence charter and their checklist, and they've privately come up with their own kind of internal house rules on how entrepreneurs need to disclose on their site. So with that, let me pause. I'm sure that you have questions, and I look forward to talking about what is most interesting to you. But before we go on, let me please hand this over to Jamie to offer some comments.
Appreciate that. Yeah, so Jamie at FrontFunder. I've been at FrontFunder for 6 years, so basically since it has started, and since then helped over 175 capital raises successfully close, and then as well raising over 200 million. We do utilize the 45-110 startup prospectus exemption, and then without, a great thing about it is that we can stack exemptions. So with the $1.5 million retail exemption, we can stack the accredited investor exemption on that. So if a company wants to raise 3 million, they can raise 1.5 from retail and then 1.5 from accredited investors. And we do often see that kind of split of like the 50-50 split of people interested in investment opportunities, especially coming from BC companies. We've seen a lot of investors kind of congregating towards certain deals, and it sort of being that 50-50 retail accredited investor split. In terms of, you alluded to costs, that I would say the cost is, there's a lot I could say about the cost. So before this exemption, companies would have to do audited IFRS financial statements in order to raise through an offering memorandum, which allows companies to raise from retail investors. So that increases the cost in terms of time, and then as well, a audited IFRS financial statement is $45,000 plus. So removing that is helpful for investors, but also companies looking to raise capital, because it gains greater access to these investment opportunities. But then also, when a company's looking to raise capital through the 45-110 startup prospectus exemption, it's just a 30-page disclosure document called an offering document. No financials required to be disclosed. And with that 30-page document, we help companies write it, or we suggest their legals to write it, but usually it lands around $4,000 to $5,000. And so it's definitely decreasing the costs. And then with it being 30 pages, it can get done quite shortly as well, within a few days to a week. And yeah, I would say those are some of the main benefits. What we've seen in terms of why companies choose to raise capital through this method, typically traditional means of capital raising through venture capitalists or angels can take quite a long time. Some have said 6 months to a year in terms of their due diligence. We've been able to streamline it and do the preparation side of things and the due diligence side of things within 2 weeks to a month, working along our marketing team as well to develop kind of a discussion about the investment opportunity, which is another benefit, and then close within 45 days. And then back to the marketing side of things, another benefit that we've seen, which has actually drawn US companies to raise on our platform, and then from our platform and to Canadian investors, is that, but that's with a different exemption. That's with the offering memorandum exemption they utilize. But with that, the companies are allowed to solicit investors, which in the States they are not. So that we've seen a lot of US company interest because of that, especially for companies looking to expand their operations in the States and wanting to get that kind of loyal investor base before they start selling in the States or in Canada from the States. Any other comments?
Let me just respond briefly to one thing you said. Well, first of all, it's great to get these numbers, and so you're saying that a traditional public offering would require this $45,000. Okay, yeah.
And then when I first started, I was working with. This is before the 45-110 offering, or sorry, 45-110 offering document prospectus exemption. So before startup crowdfunding, when I first started, a company was looking to go public on the TSXV, and on top of that, it was going to be 100 grand. So it was going to be 100.
Right. Well, so yeah, so you really have brought down the cost tremendously. And then you mentioned these like side-by-side offers. And I'll tell you that this is it's sweeping the globe. It's kind of not come to the U.S. yet, but in Australia and New Zealand, and to a significant extent the U.K. as well, practically every offering comes with, and I talk about this in the book, I call it syndication. It comes with, there's one really large investor, a venture capital fund or a wealthy individual who publicly says on the crowdfunding site, like, I'm whoever, and I've invested $350,000 in this company on the same terms that are being offered to you, because I really believe in the company. And they can say what they want to say, but the most important thing is they're putting their money where their mouth is. And the retail investors can really benefit from following the lead of a venture capitalist or an angel investor who puts in this big cornerstone funding. And at the same time, the venture capital fund also is starting to like it, not so much in the US yet, but some. It's growing. The venture capital fund, their company that they see promise in can sort of double the amount that the company is raising, and really engage. I call them in the book, they're brand ambassadors, like people that the customers or whatever the company is. They just love the company. They want to retweet the Facebook posts and such, and breweries, for example. If you invested in a brewery, when you go to the shop, which beer are you going to buy? The one that you're a part owner on. You're going to tell your friends about it, et cetera, et cetera. And so companies that raise money simultaneously from the professional investors like the venture capitalists and from their brand ambassadors really get the best of both worlds. And well, so can you tell me how common is that? What percentage of the raises that you do?
Yeah, I would say probably 50-50 in terms of us complementing a lead investor. But yeah, 50-50 probably in terms of different types, in terms of whether it be angel investors, institutional, or venture capitalists, as you mentioned. Yeah. Yeah. So we'll match the terms so that we can properly show that they've invested in this round. Yeah.
Well, so maybe let's take some questions, and then we could continue the discussion. Go ahead. Oh, yeah, sorry.
Yeah, a couple of questions. One is, what type of businesses are suitable for crowdfunding? Is there some types that are better than others? And then my other question was about the ongoing relationship with investors once they've invested.
Good, and I'll let Jamie, I think, mostly respond to these because she might know, but I can theorize. Or I could tell you this, at least in the UK has been doing investment crowdfunding longer than anybody, from about 2010. These two companies just started doing it, kind of with no legal special set of laws in place. And after a while, the UK Financial Markets Authority, I think it was, or it might have been different at the time, said more or less, hey, this is going okay. Like, keep going. We don't need to set up a whole lot of rules on this. So that's why it's a very liberal jurisdiction. And so one of those two leading companies, they're called Seedrs and Crowdcube. It's like McDonald's and Burger King. They put out just recently, within the last month or two, a 10-year report saying, here's what we've seen. So this is kind of the best information that I have on your first question as to what type of companies. And it's really broad. It's all over the place. Software and breweries and movie production studios and, somebody come up with a new type of bottle, recyclable bottle, all different types of things. So let me let Jamie respond to that and see what type of companies. And the second question, though, is what about ongoing information and disclosure? And that is, as you may have gotten from my talk, I really like the liberal, deregulated versions, but this is someplace that we need a little bit tighter regulation and enforcement. In the US, there's a rule that says in our statute, if you raise money through investment crowdfunding, you need to give your investors a report annually. And they kind of have made it so you actually have to do it once under the law. Only half the companies even do that. And this makes sense. If I'm trying to sell you securities and get you to invest, I have every incentive to give you some advice or information and tell you about it. Once I have the money, thanks, man. It's not really, may not be worth my time or I don't really care that much about staying in touch with you necessarily, with the caveat that when your investors are also your brand ambassadors and your best customers, if you treat them badly, like never talking to them again or never providing these annual reports, they might tweet, don't buy this stuff, or I hate those guys, and that could be a problem too. But let me let Jamie respond to these questions.
Yeah, so we've been working on improving that investor communication side of things directly through our platform. So right now, our marketing team is actually working on that right now in terms of developing a area where entrepreneurs can directly message their investors. But right now, we will directly update investors on really material things, so such as like go public events, et cetera. And then in terms of the entrepreneur, they'll usually update quarterly or through the AGM with their own information directly from their investor list. But yeah, we're trying to kind of conjugate that and make it more accessible just directly on our platform. And then in terms of companies most successful, we've seen real estate, tech, and consumer packaged goods, and then a lot of BC and Ontario companies, and then right now just a few more cross-border type deals as well.
Please.
Great, thank you so much. That was really interesting. So I have a couple of questions for you and then one question for you. My most important question is that, like, going back to the brewery example, when I buy the beer, I can taste the beer, see what I'm buying. With the security, it's a totally different game because, I don't get the same knowledge, right? And like you were making the argument that at least when you get audited financial statement, that, that's a very important gatekeeping function, right? So we've already dispensed with that, which I think is problematic in terms of investor protection. But I wanted to push back a little bit, your point about a voluntary disclosure. In the sense that, if we, my understanding is that the disclosure that right now, it's mandatory, it's about 30 pages. And that's almost nothing compared to what comes in a prospectus. So why do you think that voluntary disclosure would be better? And how much can you really rely on that? And the second point was is there any, and I think you answered that to some extent, is there any empirical data on how well these companies do within the span of 5 or 10 years? Because when companies get listed in Canada, we have, pretty good studies on how will people do in future, in terms of return on their investment. Do they mostly lose money or they tend to be good investments? Yeah, so thank you. And then for you was, so the way the portal works, is it that you are registered as an investment dealer with the commission? Okay, thanks.
Yes, she says yes.
Yeah.
On those are real good questions and strike right at the heart of the concerns here. But the answer is that we need to be efficient and we need to think about real life. And an investor who might, the typical investor in the US at least, invests a few $100s per company. It's just not really worth their time to read hundreds of pages of a prospectus as a Wall Street analyst would. And they won't. We could publish it, but there's all kinds of studies showing people don't read the Google terms of service, and they don't, and they shouldn't, because it's just not worth their time to do. It's definitely true that our tradition is put the disclosure out there, let people make their own decisions. But when in fact the potential investors are not going to read it and would not understand it if they did, to just spin our wheels and make the process more expensive, well, it was tried. Ontario did that, and you just can't force people to run through their this process. So I spend huge chunks of the book talking about why the potential harm of anything that goes wrong is cabined. Each individual investor can only invest a certain amount, and any company can only raise a certain amount. And all of the other mechanisms to protect investors other than giving them information and asking them to read it. And the side-by-side investors, the syndication is one of the biggest. That the person who invested $350,000, they did do due diligence. They are not, this is somebody who has $350,000 to put in. They, aren't just going to do that on a whim. And so the investors, without reading a word and without making anybody write a word, can just sort of follow along in that way. And then and there's other mechanisms as well. Like one important one that I didn't mention is the rule in the United States and the tradition across the world follows the Kickstarter model, which is quote unquote all or nothing. That the company has to announce at the outset, we need to get $200,000 of investments for this thing to work. And if only $20,000 of people say, I'll do that, then it doesn't hit its target, and everybody goes back to their corners and nobody invests. That is another key mechanism. But by the way, I'm curious as to what's going on here. In the U.S., this has been totally gamed. And again, mostly for deregulation, but some places we do need regulation. And here's one. In the U.S., the companies have been saying, okay, our target is $27. And we have a year to get there. And lo and behold, they do it. They hit it. They're of good work. But it's terrible. In truth, it's $10,000 is kind of a standard number that they put out there. But if a company can raise $12,000 but needed $400,000, it's bad for everyone for the deal to go through. And so the U.S., really, I do think we need a little bit of a regulatory fix for that. And I'd like to know about what they do in Canada. And on the returns for investors, again, I want to hear what you could say on that. It's a question I get every time. The UK, this 10-year study that just came out is the best information I have for you. And they report that if you invested £100 in every company that was ever listed on Cedars, you would have made about 8% annually, 9% annually. Some of them are out of business, maybe 25% are out of business. A couple had an IPO, a lot did quite well. And so about interesting, if you invested not $100 in every company, but the same percentage amount. So you bought 1% of every offering. So I guess that means the bigger ones you bought more of. If you did that, your returns are significantly better, like 12, 13%, meaning there's a wisdom of the crowd. The biggest ones are the best ones to bet on. But this is kind of hot off the press. But so let me turn this over to Jamie for some actual information.
Yeah, for sure. So one of the things I really like about it is that the investors are more loyal, like you discussed, so that obviously helps drive top line. So during COVID, I called every company that I thought would be struggling, and they said that they didn't want to tell their entrepreneur friends because they were doing quite well, likely because their investors were locked up, and that's all they were purchasing was their products. But in terms of actual returns for our investors, we raise for both funds and then just normal common shares. So we see returns on both ends in terms of like quarterly distributions from a real estate fund. And then in terms of just straight common share type deals, we've had a couple anomalies that would definitely skew the results, but we've had 12 liquidity events thus far. We have another one in March coming up, but yeah, we've seen if someone invested in every single common share deal, they would be up. The last I checked, it was above 50% in terms of their ROI, but that was due to a couple massive anomalies. But in terms of taking those out, it would be different. Yeah.
First question is, he said, I mean, do you believe that this equilibrium you described, where one can waste one's life savings in a casino, but not by investing them in my startup? I mean, is this equilibrium justified? And if not, why do we have it? Is it the history of lobbying? Is this politics? I mean, what's going on? Then, I mean, following Jamie's comments, respecting US companies being interested in working under our regulation rather than the US regulation, I mean, do you think, both of you, that this is a field where international jurisdictional competition should be allowed? Because as we know from other fields, such as the trust industry, the results of this kind of competition are not always happy. And then finally, you know, you were referring, Andrew, to comparisons of the amount of fraud that occur in different jurisdictions. How do we know how much fraud each jurisdiction has? I mean, you claim that liberal jurisdictions have no more fraud than jurisdictions where crowdfunding is regulated or more heavily regulated. But how do we know? I mean, can the quantity of publicized prosecutions, for example, be taken as some sort of useful proxy for the quantity of fraud that's actually going on?
Great. Let me take, I'll take one or two of those. You could talk about the international competition. So on the first question of, is there any justification for limiting the amount that people can invest in startup companies and allowing them to spend as much as they want on a vacation or gambling or other things? I think the answer is yes, because these other experiences are forms of consumption, and people get inherent pleasure from their pickup truck or their house or their vacation or the gambling. Whereas, as your colleague said here, investing lacks that component and is, you don't get anything from it except for a financial return. Asterisk, the investors really do in these companies. They want to support solar power in BC or organic farming or black-owned businesses or whatever it is. And so they do get some non-financial benefits, sort of like consumption from investing. But still, I kind of view it as kind of a trade. Let's get rid of mandatory disclosure and the costly regulations, but put a net under everybody, and they can only lose this much. On the third question, which was, remind me a moment.
The question was about how do we measure fraud?
Right, how do we measure fraud? You're right, I definitely don't know for sure. I am comparing the publicized ones, even if not necessarily a prosecution. But my life experience has been that when people on the internet have been wronged or feel that they are not quiet about it. And we would have heard, you know, these jerks stole my money or don't ever buy this stuff from at least somebody. And the news would have. So I don't know for sure, but I think that I would have heard if there were more problems.
Yeah, and we're actually speaking to the regulators next week in terms of kind of a company that's looking to raise capital from the States in Canada, and they have 20 connected and related companies. So in order to raise under the offering memorandum exemption, they would have to get a IFRS financial statements, and the quotes were $200,000. So they said, no, that doesn't make any sense. So with that, we're leading with that issue to hope that like we can start working on kind of a exemption for US companies looking to raise under the startup crowdfunding exemption in Canada. So hopefully eventually it'll come to there, but obviously it'll take a long time.
I think maybe we have time for one more question. Yeah, please.
Once I've made my investment, is there a market to sell it? Goes up to track people down to back to the process.
Yeah, good question. Is there a secondary market? And in the U.S., part of the law says you can't sell it for 1 year, first of all. Second of all, even after that, the number of shares out there is so small that it'd be very hard to actually have some sort of liquid market like the Toronto Stock Exchange. But that said, some of the platforms around the world have set up things like once a quarter. There's a 5-day window where people can kind of post, I want to sell my 5 shares in a sort of a simple way.
Yeah, so in Canada, it's usually waiting upon a liquidity event, so an acquisition or the company going public, but or if the founder has found a way to buy back the shares as well. But in terms of secondary markets, yeah, there are some secondary markets in Canada, but mostly for very large companies. And what we found with small companies, usually it doesn't make that much sense because the founder needs capital. So if there's secondary markets going on, that means the money's just going to an early investor, not the founder. So for very early stage companies, we haven't really found a market for secondary, but companies such as like InvestX are selling shares of SpaceX, which is a private company. Yeah, so secondaries do exist, but definitely in terms of private small companies, don't make as much sense.
Yeah, so I think we should probably wrap it up there. We've got another class that's going to come in. So thank you much. Let's give a round of applause to Andrew and Jamie.
Thank you. Thank you, Jamie.
Appreciate the talk, and thank you everyone for coming.